Ladies and gentlemen, good day and welcome to Galaxy Surfactants Limited Q2 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Unadhan Shekhar, Promoter and Managing Director. Thank you, and over to you, sir.
Thank you. Very good morning, good afternoon to all of you. Welcome to this conference call of Q2 financial year 22-23. Ladies and gentlemen, it gives me immense pleasure to welcome you all once again for this quarterly conference call. As it is said, offense wins games, but defense wins championships. And the first half of this year has truly tested our defense. In a half, there has seen fatty alcohol prices and freight rates correct upwards of 50%, along with a contraction in demand. A good defense, that is, robust risk management, a diverse product portfolio, and judicious price calls, combined with experience acquired over decades, enabled us to deliver an almost 100% growth in profits for Q2 and a 55% for the first half vis-a-vis H1 of FY22, thus enabling the momentum garnered in Q4 of financial year 22 to continue into the first half of FY23. Before we get into details, I would specifically like to acknowledge the efforts put in by our team at Galaxy. Given the rapid change that has occurred over the last 12 months, both on the supply as well as the demand side, consistency achieved in the last 3 quarters is worthy of praise and acknowledgement. Moving on to the business performance, it is important that we understand the structural drivers as well as the short-term factors influencing it. India continues to remain a bright spot for us. While the volumes have grown 8% for Q2 and 5.5% for H1, the bigger picture is what pleases us. Today, we are on course to touch the 100,000 metric tons sales number for India. The same stood at 69,361 metric tons in FY18, thus growing at an 8% CAGR for the past 5 years. Based on this performance, we can safely conclude that the structural uptick we witnessed during COVID has not only sustained, but as inflationary pressures ease, we can expect further build-up in momentum. I would urge you all to look at the bigger picture, which remains bright and healthy. The Africa, Middle East, Turkey region has been a point of concern. The overall volumes declined 3.5% for H1 FY23, primarily due to the 19% decline in Africa, Middle East, Turkey volumes. The local Egypt market, which makes up for approximately 33 to 45% of our total AMET volumes, has been experiencing significant headwinds on account of currency depreciation, downtrading, and cutback in demand. The Egyptian pound, which stood at 15.7 to a dollar in March 22, today stands at 24.37, depreciating 55% in just last 8 months. Downtrading has resulted in a local backward integrated player gaining share at the cost of our customers, which has adversely impacted our performance. While this may be a repeat of FY19, given the sharp depreciation seen over the last 8 months, the local Egypt market might take 3 to 4 quarters more to stabilize. But I would like to assure you that the AMET story remains intact. Given the macroeconomic dynamics of this region, while mass and masstige categories may witness a decline once in 3-4 years, they were also the first ones to make a comeback, clocking in higher levels than before. We have witnessed it in FY20, FY22, and we remain optimistic about FY24. The rest of the world has been a mixed bag for us, registering a 14% growth over Q2 and 3.6% for H1 FY23. While US and Asia Pacific markets have been stable, the slowdown in Europe needs to be tracked carefully. Europe is a big market for our mild surfactants, preservatives, as well as other specialities. If you look at our rest of the world volumes over the past 3 to 4 years, while they have remained in the 54 to 59,000 band, we remain optimistic. Yes, there have been multiple challenges, be it on account of the pandemic, which impacted consumptions in FY21, supply-driven volatility, which impacted our performance in FY22, or broad-based slowdown in Europe we are experiencing now. But despite all of this, let me assure you, the structural story remains intact. With easing inflation and improvement in global demand for premium products, we see the next leg of growth starting soon for our specialty products. Before we move on to the outlook, let me dwell a bit more on the EBITDA per metric tons, which has been consistently in the 22 to 26,000 rupees metric ton for the past 3 quarters, well above our guided EBITDA of 16 to 18,000 rupees per metric ton. The EBITDA per metric ton is a derivative of our EBITDA performance and volume growth. While multiple initiatives are being carried out in terms of product mix, operational improvements, or judicious price calls to capitalize on emerging opportunities, we need to acknowledge that the decline in volumes as well as reversal of multiple supply-led factors have also contributed to this jump. But for ensuring sustainable growth, volumes are the key. While inflationary pressures have impacted the mass and masstige segments, thus impacting our performance products, easing inflationary pressure will ensure volume growth, which eventually will result in correction of our EBITDA per metric ton as and when the same happens. This will be particularly true as the AMET volumes recover. But for now, given that we have been consistently clocking an EBITDA per metric tons of 22 to 25,000 rupees per metric tons for the past 3 quarters, we would like to revise our EBITDA guidance for the year to 21 to 22,000 rupees metric ton from 16 to 18,000 rupees per metric tons. While the prerogative remains on ensuring volume growth, given the slowdown and volatility we are witnessing globally, meeting the previous year volumes should be good. Having said that, we aspire for a 2 to 3% volume growth, but for that to happen, we need a more conducive demand environment. While we never issue any half-yearly or yearly guidance, this is being done to give a true picture of the current situation. Going ahead, we will always aspire for a 6 to 8% volume growth, with EBITDA growth being 300 to 400 BPS above it, and a ROC of minimum 22%. The structural framework that has enabled our growth over decades remains the same, and volumes are an integral part of it. To conclude, ladies and gentlemen, it is said that the successful warrior is a man like no other with a laser-like focus, and it is this laser-like focus great defense in terms of risk management and an optimistic approach that will ensure your company continues to march ahead. Thank you very much once again, ladies and gentlemen. Thank you. Now over to you for your questions.
Thank you. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good afternoon, everyone, and thanks for taking my question.
Good afternoon, Sanjesh.
Thank you, sir. I got a few questions this time, more than two probably. First, on the emerging business model, we have changed our guidance both for EBITDA and volume, one for better and one for inferior from the long-term perspective. Do you think this model sustaining more than FY23? Will this be flowing to FY24? Because you also made a commentary that Egypt may take another 3 to 4 quarters to stabilize. That means a significant portion of FY24 volume again is at a risk. Considering a low volume growth scenario and a better mix in favor of India and ROW, do you think this higher EBITDA sustaining beyond FY23? That's number one. And number two, do you also see that in a longer term this could be a more emerging model than the volume growth? Is that a possibility, or we would want to go towards more volume growth than an higher EBITDA? How do you see the model?
Good, Sanjesh. See, as we very clearly said, we want to grow ahead of the markets in terms of volumes. That is the fundamental structure on which we would like to operate. Nobody can forecast the future with respect to the growth or decline in the industry. Of course, however, we do believe that these are short-term blips. The long-term story is very much intact. So we would expect, once some sort of stability comes into the world scenario, the volumes will pick up with respect to all the segments, whether it is masstige, or prestige. So to your second question, the answer is we would always like to focus on volumes because we need to grow with the industry and grow ahead of the industry on all segments of personal and home care. Okay? So when and whenever the volume growth happens in a normal or a secular trend, our EBITDA per ton will automatically adjust itself. So, however, as I have told you multiple times, the EBITDA per ton will securely move up because as the world gets to become more and more premium, as penetration increases more and more, the requirement of specialty ingredients will increase. Okay, so that's the answer. I hope I have answered your question.
Oh, first part of the question was also related to how to see FY24 more near term. I know
we cannot really predict. Okay, I just said so many things can happen. Okay, we would wish that the world returns back to normalcy and you have growth on all categories, on all fronts.
Just to add that, what worries me a little bit is that AMET continues to struggle for us. Egypt market, as you rightly said, the local guys are gaining the market share, and this time the drag looks like it's more longer than what it happened 2 years back or 3 years back. Number two, Europe continues to struggle. One of your peer in his call said that the preservative, non-toxic preservative which they sell in Europe, they are seeing a headwind there. So if these two happen, then we are looking at a risk both to volume as well as margin, right?
Yeah, Sanjesh. So this is Vaishnath here. So I think thanks for this question related to AMET and Egypt, because yes, the numbers surely expresses the concern, but we need to understand what exactly happening in that part of the world. You might have noticed that last 6 to 9 months, consistently, specifically now I'll talk about Egyptian government because that is a significant share of our AMET market. The government's entire influence was to drastically reduce the imports and put barriers because this currency was under pressure. IMF was negotiating with Egyptian Central Bank, and this was more or less a replica of what happened in 2016 if you really go back and check. So obviously the availability of foreign exchange was completely controlled and many local home and personal care industries, though we produce and supply significant amount of ingredients to them, they are also dependent on certain critical imported ingredients. So they were really choco-block in terms of getting things into the market. So this was affecting the operations in almost all the customers in Egypt. Apart from that, the supply chain had not really fully restored in the region, which we are seeing that is now substantially restored since last few months, and we see that it is almost getting towards normalization. So two important points, that the currency, the devaluation now, which was about to happen, now that has happened. The event has happened. The currency is on float. The negotiations are over between the country and the IMF. This, if we can correlate with 2016 exercise was similar. We had seen that it took almost 4 to 5 months time for the market to fully absorb the impact and start resuming the normal demand curve. We expect it to more or less follow the similar trend, and this is what our interaction with our customers in that particular country has shared with us. The consumption of home care and personal care products per se, they are good in the country. The habits are seasonal, so we don't expect it to follow any different trend than what had happened in the last major currency change that had happened. And so recovery should be visible in 4 to 6 months time, as we have discussed. And the added factor is that supply chain is a good normalcy is experienced in the region. So that should also smoothen the accessibility of imported raw materials, and the market environment should normalize. So our prediction is based on that understanding. The only one factor which is beyond anybody's guess is the Ukraine-Russia war situation is affecting Europe, and Europe is close to Mediterranean, Egypt is in that region. We will not be really able to estimate those impacts, but we feel that more or less it is isolated. The energy costs are very much maintained in the country. So I think things should normalize in 4 to 6 months' time. And Egypt constitutes almost 35% of our amid business. That had taken a hit, and once that's restored, I think we should come back more or less as far as our story in AMET is concerned.
Thanks, Viju, for that detailed answer. Just one related question to that. Now, at the peak, AMET contributed 91,000 metric ton. We are at 65 this year, probably there about where we will close this year. But we are lost close to 30,000 metric ton there. We couldn't place that anywhere in the other geography, say in Africa, in Europe, in Latin. No, that's a very big loss of volume we have.
Yes, Natarajan, yeah. So that is obviously is the way we look at it. But if you look at entire Africa, was also troubled with food inflation. They had their own challenges, because all the economies in Africa aren't doing that well. So import, as we, getting material out, there were supply chain issues until almost June. Getting material out, then the demand in those countries also were not conducive for us to be able to place those volumes. If you look at previous years, when it was only, the problem was only with local Egyptian currency depreciation, we had a good opportunity to be able to place those volumes into other markets in Africa and Middle East. Now, this problem seems to be across, the Africa and Middle East. Turkey was again a bright spot last time, and Egypt market had an issue due to the currency depreciation, but even Turkey now is an issue with the way inflation and currency depreciation happened. So this has been a very unique situation.
Got it. And any comments on the Europe and your peer talking of...
as Sanjesh, you know that we never give half-yearly revised guidance. We have given it for this year because we know that there is too much amount of moving parts as far as the macroeconomic environment is concerned. But yes, we need to be giving some sort of a proper guidance specific only to this year, because we want the investors to be having a good picture about what we see by end of this year. But yes, if you ask me, we would like to be decoupled from the global macro environment and what happens in Europe in terms of their demand. But yes, it doesn't work that way. So what is our objective very clearly? First is to prioritize volume growth. And we need to be growing ahead of the market. That's very clear. So, if the global economy doesn't grow, degrow, then obviously, yes, we need to see whether degrowth is lower than the degrowth of the global economy. That is one. Second is, the EBITDA per metric ton is always a derivative, okay, of the business model that we have. So when a situation is there where there is a macroeconomic environment preventing you from growing volumes in the 6 to 8% band, the only lever available with us is to how do we now then look at various opportunities in terms of operational excellence, getting our costs properly done, and then ensure that we are at least able to deliver a growth in EBITDA. And that's what we've been doing. That is testimony to the capability of our team as also our business model. The way we manage risk, the way we manage our operational efficiencies is what is going to ensure this. But yes, we want to come back to the 6 to 8% volume growth, and EBITDA will be a derivative of that into the 16 to 18,000 per metric ton that I've been talking about. And that should happen as AMAT volumes pick up. If Europe again picks up pretty well, yes, we probably will be at the higher end of the EBITDA per metric ton of 18,000 per metric ton in the subsequent financial year of FY23-24.
Thanks, Natarajan. That's quite clear now. I have few more, but I will come on the queue. I think I've taken more time.
Okay, Sanjay, thank you.
Thanks for all the answers.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question on the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi sir. Good afternoon and thanks for the opportunity. Congratulations on a good set of numbers despite the challenging environment, sir. I heard you that in terms of the margin guidance, 21 to 22,000 rupees per ton, and though I understand it may be mainly driven by the product mix, sir, just want to have some more clarity in terms of like going ahead, though it will be applicable for the current year. But the focus is, as you rightly mentioned, is more on the volume growth. So when we are striving for volume growth and going for 8 to 10% volume growth trajectory in a medium term, do you see that it's a absolute necessary to dilute the product mix that will pull down the overall margin? I mean, if we in the current scenario can maintain a 21 to 22,000 rupees margin trajectory, why you see that once the focus will be more on volume growth, the margins have to come down and fall down to 16 to 18,000 rupees EBITDA range? So I just wanted to understand that is it absolute necessary the deterioration in product portfolio, product basket, or I mean why the margin depression contraction will happen?
We want to once again clarify on our approach. For us, EBITDA is not a target. EBITDA is a derivative. Okay, our target is always the market, our customers. We want to grow with the market, grow ahead of the market. That has always been our approach, and that will continue to be the approach for the next, whatever number of years Galaxy is going to be there. Because it's important for us, market is the most important thing, customers are the most important things, and volume grows along with the market. Repeat, EBITDA is a derivative.
Yeah, Rohan, other thing what we need to also probably keep in mind is that our objective will be in terms of growing in both the developed and the developing markets, grow the legs of both our performance of surfactants and specialty care ingredients. That's the way it will be. Now, it is our effort. Now, how the way the market really evolves, okay, it's quite possible that once the growth starts coming back, it's quite possible that, you will have performance products doing significantly better because it has been degrowing, because, your AMAT will come back. And then you'll also have demand for specialty ingredients in the rest of the world giving you a momentum. So that's what I said. For us to be looking at revising guidance, we need to see a steady state. If it was a steady state in the global macroeconomic environment, and our efforts then will determine as to how we partake. But here is a situation where we're at the receiving end of what the global macroeconomic environment is, and we don't have a clear picture how it is going to evolve in FY24. So what we're telling you is based on what criteria as of today, given how we approach business.
Got it, sir. Sir, second question is on our specialty care product basket. So I think that market is primarily driven by Europe and maybe US, primarily US market. There also slight dip in a volume. I understand on the market. Sorry for getting a lot of noise.
Yeah, it's clear now. Hello? Rohan, are you there?
Can
Hello?
you hear me now?
Yes, Rohan, we can hear you now.
Yeah.
Okay. So, sir, I was saying that coming back on the specialty care product market, so I understand the performance surfactant, the pressure on volume, but specialty care markets are more in a US and Europe driven market, and there also in this quarter we see some weakness in volume. So, this specialty care market, which is where we have already added capacities in first half, I mean in the end of the last year, probably that we are our operating leverage will not be playing here, and utilization level will be quite low as of now. So why there is a pressure on a specialty care product market when in last 2 to 3 years we have seen that the specialty care has done very well, and we have added many products and have also commissioned the additional capacities?
Yeah, correct. So, see, if you look at it, Rohan, is that the rest of the world, which is majorly driven by specialty ingredient market, if you look at it, it has grown by almost 3.5% in the first half. And if you look at quarter on quarter, it's grown by almost 7 to 8%. But the issue that we need to be cognizant of the fact is that the major impact is because the way Europe has been not measuring up. So yes, we do have the products. There are certain projects in pipeline that were maturing, but then people in the given scenario where the demand itself is under question, people have taken a step back. So this will come back once the sentiment changes. See, finally, any new product introductions with specialty ingredients requires the sentiment to be positive, correct? Whereas US has been a bright spot in terms of specialty ingredients because that has been holding up, at least as of up to quarter 2. And Asia Pacific also has been stable. The concern obviously is Europe, and all of us know why it is so. Once that starts turning around, things will start looking better on the specialty ingredients. We are ready now.
Yeah.
We are ready.
One other very important thing to note is the macroeconomic environment with respect to inflation in these developed markets also has an impact on the sentiment with respect to consumption. That is one. And number two, we also hear, of course, this is not validated or proven, that all the major customers as well as the retailers like Walmart had overstocked themselves in the context of the supply chain issues which the world experienced, and they are now de-inventorizing as far as their pipeline is concerned. So this is also will have an impact for maybe a few months or so. Of course, this particular thing, I just wanted to tell you that this was what was told to us. We have not validated it as yet. Okay, these are the two primary. One is the macroeconomic inflation impacting the sentiment of consumption, and two, de-inventorizing the pipeline.
Got it. Sir, the third, if I'm allowed to, and otherwise I can quickly go back into queue. We have seen a sharp fall in fatty alcohol prices, went almost to $1,500, quite sharply corrected from almost $2,900 at the peak level. Still, somehow the correction in raw material prices is not visible in the inventories. Like our inventory level are still at almost 700 crores. 775 crores in September versus March. And also there has not been very sharp correction in the trade receivables. Actually, it has gone up. So this raw material prices led correction, and falling raw material prices should have led to lower working capital requirement. That is not visible. Just wanted to understand the primary.
Very good.
Yeah, Rohan. So what needs to be understood is that the raw material price started correcting significantly since end of May, June. So obviously you also have the contracts don't get done 1 on 1. So you'll have contracts that will flow in through what you have done prior to the correction happen. The other thing, so obviously you will start seeing the impact in the coming quarters in terms of the lower price of the inventory. The other thing also is that the inventory in the pipeline also was enhanced, where given the supply uncertainties that were there, now that is also something that will start getting corrected. So the receivables again are not reflecting because my receivables are based on what was sold in the month of June. Typically you'll see about 60 days is our receivables position. So they reflect what was sold even at the higher feedstock prices. So you will see this reflecting in the coming quarters progressively.
Okay. Got it, sir. Thank you very much, sir. I will come back in queue for the further question.
Thank you. Participants who wish to ask a question may press star and one on your touchtone telephone. Participants who wish to ask a question may press star and one on your touchtone telephone. We have the next question from the line of Pujan Shah from Congruence Advisors. Please go ahead.
Yeah, sir. My two questions from my side. First question would be, can you just give us the possible geographical volume for H1?
Yeah. So it was considered as, I think, 42.
It was about, H123 was about 51,000 in India, rest of the world.
Percentage.
No, you wanted the volumes or the percentage growth?
Percentage.
No. I just want the split of the volume for H1.
Yeah. So this is.
Yeah.
Yeah. So the split of the volumes is something that we don't. So it typically is something that we don't want to be talking now. Okay, but that's something that we want to keep it with us. We only talk about the category of customers in Tier 1, Tier 2, and Tier 3.
Okay. Got it. And my second question would be, on a previous call, we were saying that US has been a pretty good demand. We are seeing a pretty good demand on that part. And currently, we are saying that the US demand is being currently at stable point of view. So are they being inflationary point of view? They are waiting for a couple of months to stabilize and they start to for the distribution or something like that, or it's been like the US has been pretty strong currently as well?
No. So if you look at it, last year same time US was extremely strong in terms of demand. Now that obviously is got a little bit tempered. So US is not as, the sentiments are not as negative as what we have seen in Europe. We need to wait and watch as to how things are going to pan out in US. At least till Q2, when we have been speaking to our customers in US, they have been not that very negative. Although they did say that they are seeing correction, as Shekhar also explained earlier, there is inventory correction happening in the US at by the retailers, like a Walmart or a Target, which is obviously getting passed on, to everyone in the value chain. So that may be an issue that needs to be kept in mind. Now, whether the consumer demand is going to turn negative in US, we need to wait and watch. We are not seeing such indications as of now.
Okay. Thanks, sir. That's on my side.
Thank you. We have the next question from the line of Rohit Nagraj from Centrum Broking. Please go ahead. Mr. Rohit, can you hear us? This is the operator. Mr. Rohit, can you hear us? The participant has left the queue. We have the next question from the line of Jasdeep Walia from Clockwine Capital. Please go ahead.
Hello. Good afternoon, sir. Thanks for taking my question. Am I audible?
Yeah.
So my question is specifically on the betanes part of your specialty portfolio. So what I want to understand is it the slowest growing part of the specialty portfolio? And if yes, what are the reasons behind the same? And is this also one of the reasons why this growth in specialty has been low over the last 1 or 2 years?
No, there is something like that. I don't know. How did you come to that conclusion?
So betanes is it's growing at around 6-8% kind of volume CAGR as the other parts of the specialty portfolio.
No, correct, but I am not able to understand because we never specifically talk about each product within the category. So I want to understand from where do you get this information on betanes degrowing and that being a problem. So then I will be able to answer your question.
So broadly spoke to people in the industry, which who gave, yeah.
Okay, so that obviously is not right. So it may be specific to them.
Yeah.
Okay, so it is not. So that you can. I think you probably need not keep that in your mind.
Got it, sir. So my second question is on the APG class of surfactants. My understanding is Galaxy is not present in this market, whereas this market is much bigger than the amino acid-based surfactants. So what are your long-term plans with respect to launching products in this market?
Yeah, so mild surfactant is a strategic category for us, a significant part of our specialty care ingredients portfolio. APG is one of the mild surfactants, and yes, that is in our radar. And at the appropriate time, we'll be able to tell the market as to what our plans are about that. As of now, we would not like to be talking about what we're thinking on that.
Got it, sir. Thank you. That's all from my side.
Thank you. We have the next question on the line of Rohit Nagaraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So, in terms of the customer product commercializations, due to the current issues and inventory destockings, have there been any delays from their end, and probably that will have some consequent impact on our volumes? Thank you.
There are, which I did explain earlier in response to a question on similar lines, that yes, the sentiments are not as bullish as it was same time last year. So certain projects are getting a little bit pushed. Okay, because earlier we had an issue because of COVID on the supply side. There's some of the projects in pipeline got delayed. Now there's a demand sentiment having turned negative. We do see some. There have been some that has moved well. Some of them will see some delay. But overall, what is critical is that we are ready now, okay, with our capacities and ready to serve the market moment the demand sentiment starts picking up.
Right, got it. So second question is in terms of India growth. So the volume growth has been again relatively muted, and fortunately there are no headwinds that are being faced by other global countries in India. So is there any possibility of this India growth accelerating to maybe 8-10%, and what could be the levers for the same? Thank you.
One thing is, I don't know, you mentioned that India growth has been muted. Now, is it India as an economy or Galaxy India business? So I wanted to understand that.
No, I said that it is about 6% as of now, and our economy is doing pretty well.
We would like to share your optimism. Okay, we would wish that India grows at even much faster rate. Okay.
Yeah, and that will be good.
Yeah,
that will be good.
Right.
India certainly as an economy is in a very bright spot.
Yeah.
And we would like it to get better and better.
Perfect. Just one last clarification. So you mentioned that our focus next year would be on volume growth, and that could have
for years.
Generally, right. I mean, yeah.
For all years.
Right. So it will be predominantly on volume growth, and the EBITDA per ton would be a derivative of the same. So this year, since the volume growth seems to be muted and the EBITDA per ton is higher, next year given just mathematically speaking, would the performance be more or less similar to FY23, given that we have the volume growth which we are targeting? Thank you.
Yeah, you're right. I would be happy if the business follows the rules of mathematics, but unfortunately it is not so. So what is important is we being ready, we understanding the markets, our deep customer engagements, and able to ensure that we are able to keep growing our volumes with them, be ready with our supply side capabilities, and yes, the EBITDA as a derivative will obviously be good. So the issue is that we need to be very clearly focused on our strategy. Only thing is that the external environment has to be conducive, which obviously has not been on the demand side for the last 6 to 9 months. We do hope that these things, everything has to come to an end. So even this particular negative sentiment on demand side should turn around, and then we are well positioned to be able to grow our volumes into the 6 to 8% range that we've been talking about.
Right, sir. Got it. Thanks a lot, and best of luck.
Yeah.
Thank you. We have the next question from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Thanks for taking my question again. Couple of bookkeeping questions.
Yeah.
First, on the employee cost inflation, it's quite high for last 2 to 3 quarters on a YOY basis. Even in the standalone India, I can understand for outside of India, given the currency movement, but India inflation remains quite high. What's leading to this employee cost inflation? That's number one. Number two is on the tax rate. Now, India minus Concall minus standalone, if I do a subsidiary numbers, there again the tax rate is around 15.5%. MAT is a tax free for us, so it's all what we are paying tax in America, and that means around 50% of our PBT is coming now from US, and a bit the contribution from MAT has significantly come down, and is that leading to the tax rate going up in the subsidiaries business? These are my two questions.
Yes, Sanjesh. So this is Abhijit here. You are right, the employee cost has increased. I mean, the primary reason is the normal increase in the employee cost year on year. Plus, you already mentioned the reason of currency depreciation, which gets translated, the translation of subsidiary companies into INR. And the other part is, we have recently, last year, if you see, we were into 2 projects into the pre-capitalization stage. So now we have those projects up and running. So additional manpower on account of the 2 projects have also been flown in the P&L this year. And your next question on tax.
Also, tax. And the other thing also is, Sanjesh, last year base, if you compare, the variable pay was not provided for based on the muted performance we had. But this year, the variable pay and commission for the employees eligible for that have been provided.
And tax rate, you rightly mentioned, it's basically the subsidiary tax rate will be dependent upon the composition of the Egypt and Tri-K profitability. Egypt being a no tax zone, and accordingly that variation will always be there.
However, as we know, the corporate tax rate in India is 25%. For US again, it is about 28%, and Egypt is 0.
So US is a 30% tax rate or more than that?
No, it will also be around 25%.
Around 25%.
Around 25%. Okay. That's it from my side. Thank you.
Yeah.
Thank you.
Thank you. We have the next question on the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Hello. Yeah, thank you for taking my question, sir. So one question is on the capex pipeline for 23 and 24, FY23 and 24, and secondly, just trying to understand the volume outlook. I mean, if at all right now, as we are talking about the Europe slowdown and which is impacting the volumes. So considering that these things get prolonged for maybe 6 months more or 1 year, so what we would be targeting at, whether we would be looking at operating at lower utilization level, or would be looking to address the new market from whatever production level would be.
Yeah, so first on the capex, so I think 23-24 also typically our capex per annum has been close to 150 to 175 crores. So that is essentially be continuing into 23-24 as well. Now, our capacity utilization is about 67 to 68% as of now. We don't expect that to be significantly different next year unless the demand environment corrects much more significantly. And yes, our clear thing is to ensure we grow ahead of the market, and we want to stick to our volume growth target of 6 to 8%.
So 6 to 8% right now, as we are seeing this Europe situation as well. So taking into account that. Yeah. Yeah.
So what is happening in Europe is only known to us after things have happened, but we need to be moving with what we want to be targeting. So the objective is to see which markets we can garner, which new customers we can add on. So that is a constant effort that we do, because our key objective is to grow ahead of the market. Well, the market, when we say we want to grow at 6 to 8%, the market has to grow at least at 3 to 5%, correct? So we do expect that things should turn around, the demand environment should become conducive to start growing at those levels, and yes, we want to be targeting that. And that is what drives our business initiatives in terms of our desire to grow volumes at 6 to 8%.
Okay. So that is what I was trying to understand. I mean, if at all, in case the Europe situation get worse or still going to impact our volumes, so which region would be our next target to maintain these kind of volume growth?
Galaxy, as you know, sells its products across the various regions in the world. Okay, as you know, the general macroeconomic sentiment across the entire world, there is a high level of inflation, which is impacting the consumption sentiment, which is what we need to be aware of and alert about. Okay, so out of all these things, what we have seen as a bright spot is one is of course India, and number two USA. Even in these two countries, the sentiment vis-a-vis inflation is not as encouraging as it was in the first 2 quarters of this particular year. So we have to wait and watch for this particular quarter, that is September to December, as well as January to March.
Okay. And one last thing. I mean,
Hello? I think the line dropped.
Mr. Sinha, can you hear us?
Yeah.
Mr. Rohit Sinha, can you hear us? It appears the participant is no longer connected. We move on to the next question from the line of Ajinkya Jadhav from Kamyaka Wealth Management. Please go ahead.
Thanks for the opportunity. We understand.
Your voice is not very clear. If you could go off the speakerphone.
Okay. Hello.
Yeah.
Am I audible? Yeah.
Yeah.
Yeah. Thanks for the opportunity. We understand that the raw material prices have gone down. So going ahead, will they continue to go down for the, let's say, FY23-24, or will they stabilize at this point, at this price level?
So we don't have a crystal ball in front of us, but what we can only understand is that if the global demand is going to be not very robust, you suddenly have commodity prices being lower, and raw material prices would be lower in sympathy with the commodity prices being down. But we need to wait and watch. As of now, we are not able to make a clear statement on that. Our objective is to ensure that we have to manage the highs and the lows in a way that we don't have any risks flowing into the P&L. So that we are very conscious about. But we don't have any clear statement on how the raw material prices will be in the next year.
Okay, sir. That helps. Yeah. Thank you.
Thank you. We have the next question from the line of Rohan Gupta from Nuvama. Please go ahead.
Sir, thanks a lot for the follow-up.
Yeah.
Sir, the volume growth guidance which you're talking about for the current year is 2 to 3%. I understand, sir, that is for the full year, right? Because our first half has almost been close to negative 4% volume growth. So we're still looking 2 to 3% for full year volume growth, right?
Yeah, that is what we are aspiring for, with a caveat that the demand environment has to turn conducive. So that is what we are aspiring for.
Got it. Sir, second is that the poor performance and the pressure in AMET market. So just to dwell a little bit deeper, so in AMET, is it mainly because of the Turkey we are facing all these issues, that market is continuously pulling down because of the country itself is facing multiple challenges, or you see that even Africa and Middle East are also contributing to the similar way in terms of the poor performance of AMET region?
Yeah. So as I explained before, Egypt and Turkey, both countries contribute the significant share of the AMET region volumes as far as and then in that I explained the Egypt case in detail. So we expect the currency has now settled, the free float is there, the foreign exchange availability has started to ease out. Supply chain situation has almost coming to normalcy. So based on our past experience of 2016-17, we expect the volume recovery should start in 3 to 6 months time frame to come to its normalcy. Turkey also has undergone a similar severe inflationary pressures. Currency has almost devaluated more than 100% over a period of a year. So it had seen an impact progressively getting built up over a period of 9 to 12 months, not that it has happened suddenly. But now we feel that it has come to some state of equilibrium as far as the country is concerned. So these two countries, since they contribute something like 60%, 60-65% of our total volume, we believe that in next 3 to 6 months time, the recovery of volume should be visible very much. Turkey also is an attractive low-cost export destination into European market. They don't have any significant energy crisis, so we believe that even Turkey should start to catch up their export businesses into rest of the Europe is concerned. In turn, our export to Turkey also should resume to its normalcy. So I think, and that governs the significant story for us in AMET region. Specific point to rest of the countries in Africa is concerned, they have also undergone not equivalent depreciation of their currencies, but there are visible signs of inflationary pressures. The lot of food supply chain has got disrupted because of Russia and Ukraine war. So to an extent, there is a disequilibrium in terms of demand there, but is not as severe as we have seen in Egypt and Turkey market. So significant amount of our recovery will continue to depend on Egypt and Turkey market. And we just expressed that the time frame we believe is something like 3 to 6 months based on our past experience. We have to wait and watch how Europe situation further settles down. So that's how we look at it.
And so you mentioned Egypt plus Turkey put together roughly 60 to 65% of your total volume, or it's the AMET's volume?
No, we restricted to AMET as a region.
Okay, so 60 to 65% of the AMET volumes come from Egypt plus Turkey.
No, we haven't, we wouldn't like to what is called give those breakups.
Yeah. So Egypt and rest of AMET, so Turkey is one of the significant.
They contribute a significant proportion of the AMET region business.
Sir, earlier you used to share the regional breakup. I'm not asking for the particular current quarter, but possible for you to share the revenue mix of India, AMET and ROW now?
I think we have already done that even in our presentation which we have filed.
Okay.
It is share of India, AMET, the rest of the world is 40, 28, 32 for the first half. 40 is to 28 is to 32.
Okay. Thank you, sir. Thanks, sir. Thanks a lot for answering all the questions.
Thank you.
Thank you. We have the next question on the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question again. Just follow-up question that in terms of pricing scenario right now, since we are seeing the inflationary pressure across the world, so how the contracts with our customers getting revised, and is there any particular, cycle which is there, or it is, a mix of 6 month or annual contracts which getting revised regularly?
Yeah, without getting into specifics, typically these things get revised on a quarterly basis, and then that's normal. There's nothing different that we're doing in the current year.
Okay. That's it from my side. Thank you.
Yeah.
Thank you. That was the last question. I now hand it over to the management for closing comments.
Thank you all, ladies and gentlemen. Have a very, very good day. Thank you very much once again.
Yeah, thanks all of you. Thank you. Have a good day. Bye-bye.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.